Here we go.
Could record?
Yeah, we're recording.
Okay, hello everybody. Can everybody hear me out there? I don't know if you can do a thumbs up or you can say hey.
Patrick, can you hear him?
Yeah, we're good.
Okay, good.
Turn on your video, or
Yeah.
you're not wearing clothes. There you go.
I'm naked, Troy.
Okay, well, hey, my name's Ted Vagnier, and I'm a neighbor and a friend of Troy's, and we often sit around and drink a beer or two and think we can solve the world's problems, and we concocted an idea where we would talk some tax tips specifically targeted at new agents, but I'm sure many of you that are long in the tooth know that refresher training is not always a bad thing. So I put together a really short brief here. It's meant to be interactive, maybe spawn some dialogue, but I really want to just go through essentially a newly appointed real estate agent all the way through remitting your first set of taxes, whether it be a quarter or for the year. So I'll go ahead and see if I can't share my screen with you. And we'll get this started. And again, I'm not going to read these slides right off. You all can read. And if you want to take a copy of these with you, feel free to do so. They're not perfect. If there's spelling errors, blame Microsoft. And then we'll kind of close at the end with a very small vanilla vignette about what a potential agent might do when they encounter their sale of a home, ultimately through remitting taxes to the appropriate agencies. So first, let's see here if I can figure out how to switch slides.
Should just be able to.
There we go. Okay, so you're looking at the agenda now. We're going to talk for the first 2 or 3 slides about independent contractors. And there's a few points that I kind of want to beat home as far as transitioning yourself, whether you're an employee now and an agent or just an agent. There's some pretty drastic differences between the two. And a little bit about me, I retired in 2019 from the Army. And I've spent the last year, all of 2020, taking tax classes. It's part of a CPA program designed for those with non-accounting majors to ultimately sit for and pass the CPA exam. All this is focused on taking over the practice that I work at now, which is my father's. And that's a little bit about me. And I can tell you, I was an employee for all my life. And independent contracting is a very different dynamic for those that are used to having an employer hold all your taxes, remit all your taxes for you, and you get a $3,000 tax return at the end of the year. It's something that I was very used to and very accustomed to. And what I want to drive home with the independent contracting is that it's a paradigm shift in how you think about money, specifically revenue and expenses. So we'll talk about that for a minute, and then I'm going to kind of sort of talk about some various tax differences between, say, an employee and an independent contractor. Then we'll kind of dive into specifically real estate type items, common expenses, etc. And then we'll go through a little vignette of the sale of a home. And then I've got the last slide is some resources for you to at least familiarize yourself with. So, okay, with independent contracting, you know, the United States government gets real sensitive when people want to claim themselves as independent contractors. And you see this a lot of times in construction, you see it in food service, and I'm willing to bet you see it in real estate too, is it's just much easier to pay somebody on a 1099 because now the employer is not required to withhold any taxes for that individual because it's, again, they're deeming them not an employee. And that person that's operating as quote unquote the independent contractor, even though they're really operating as an employee because the boss is telling them what to do. If a boss is telling you what to do, then you're an employee. And so at the end of the year, say you work in construction and you've made $40,000 a year, you've accrued no expenses because in your mind, you think I'm just getting a 1099. That's the same as a W-2, right? Well, it's really not. And you're going to find yourself with probably a pretty big tax bill at the end of the year. And that's what kind of this brief is all designed on. It's not designed on how to pay less taxes. It's designed on how to pay your taxes smartly and efficiently, because at the end of the day, we all have to pay taxes. Taxes do many things for our society, whether you agree or disagree. It's just something that we're all required to do. Pay taxes and die. So I just want the one takeaway, the foot stomp on this slide is that if you are telling, if say you are an agent and you're looking on bringing on additional agents on your team, so on and so forth, that if you're telling them what they're going to do and how they're going to do it, so the results and the means, they're probably an employee. So what happens here is the government gets really, again, sensitive when people want to start paying people with a 1099, because whether it be right or wrong, I think the government kind of looks at it as though that person might be trying to dodge out on taxes, whether it be income taxes, FICA there, that's the combination of Social Security and Medicare. Unemployment, that's your FUTA taxes, that's your federal unemployment. And then there's your SUTA side of the house, which is your state unemployment. You got workers' comp you got to pay. And then if there's a prevailing wage in that state, they might be dodging the prevailing wage by issuing a 1099 to their quote employee, which is not right. And so what I always tell people is the rule breaker or the tiebreaker in this type of scenario is to refer to the SS8. The SS8 essentially serves as a checklist from the IRS to deem if that person is operating as an independent contractor or if they're operating as an employee. So I would just, my only bit of advice on this is don't mess around. If the person's an employee, then you need to get a payroll service and you need to withhold taxes for them. If they are a pure independent contractor that works in your organization, then you're okay. Okay. All right. So you all know this because many of you are serving as independent contractors, but you are essentially a sole proprietor. You could be organized as an LLC. There's lots of different tax structures. There's limited liability partnerships if you're in it with somebody else. These are what often is referred to as pass-through or flow-through entities, meaning that your revenue actually flows through your individual tax return. And again, you don't have to be a business. The IRS you will pick up all your revenue on your individual tax return, which is your 1040. And so all the expenses and everything else that we're talking about while you're operating as a sole proprietor, which in this case, let's just make that synonymous with an independent contractor, is really three big tax documents that you want to wrap your head around are the 1040, which is your individual return yourself. You've been filing those for years and years. But a new addition might be a Schedule C. And a Schedule C closely mimics what a profit and loss or an income statement would be. It's revenues at the top, it's expenses in the middle, and you result in a net income at the bottom. And that net income is what flows through to your 1040. And then we'll talk more about this later. There's a form 1040-ES. This is a voucher system to remit taxes on a quarterly basis to the IRS. There are some easier ways, I will say not easier, but there are some more automated ways for those tech savvy. All this can be done through website, and I've got a link to it at the end. Okay, so this is my last foot stomp on the independent contractors and the employees. But as an employee, one has been used to having all of the federal income tax, the state income tax, Social Security, and Medicare withheld from their paycheck. And then that is remitted every period. And it depends on the type of organization as to how often they remit, whether it could be weekly, it could be semi-monthly, it could be quarterly, et cetera, et cetera. But your employer is remitting all those taxes on your behalf tied to your Social Security number to the IRS. The IRS is got a little ledger, and they know that Phil Dunphy has, withheld $7,000 this year. And then when you go and do your tax return and you determine how much it is that you owe, you get to subtract off the $7,000 that your employer remitted for you. Well, as a contractor, it's your problem. It's not the employer's problem, it's yours. And so, again, this isn't meant to be a class on making you tax experts. It's really just to identify some of the requirements that are out there. And so you don't get yourself in the bind when it comes to the end of the year. And I can tell you after numerous conversations with Troy, it's really kind of complex for realtors. And the most confusing thing for most, and myself included, and tax practitioners in general, is the municipal tax. And we'll talk about that towards the end of the brief, but it gets a little bit tricky. And so as as a sole proprietor or an independent contractor, as a real estate agent, you've really got to be keeping score of what you owe the federal government, the state and local, that's the municipalities I talked about. And then what they call payroll taxes are often referred to as self-employment taxes, or often referred to as FICA taxes, which again is that Social Security and Medicare. And I'll do a breakout. It gets a little tricky because as a sole proprietor, this is a tough concept to get your head around, but you are both the employer and you are the employee. And hopefully that will make a little bit of sense at the end as we address how you remit the Social Security taxes. And then one thing that this brief is kind of designed is to talk about remitting those taxes on a quarterly basis. But I just want to let everyone know that you don't have to wait to the end of the quarter. And one practice that I might recommend, if you're maybe a small individual agent working on your own or whatnot, I would remit taxes as soon as I sell a house. Every house I sell, I'm going to go ahead and just go into that website and I'm going to remit the taxes right away. And that way it's out. And there's what I call a vanilla vignette at the end, and I'll talk about that a little bit. But you don't have to wait to the end of the quarter. Okay, so now we're out of independent contractor land. We're all independent contractors, we're real estate agents, and we're moving forward. So getting started, and this is specifically targeted for those that are brand new to the industry. And first things first, what I call the big rocks is here's where you got to do the refine ideas. You got to answer the why. Not sure if there's a lot of Simon Sinek fans out there. There's a wonderful video called The Golden Circle, and begin with why. Why you do something, how you do it, and what you do. Help yourself delineate why you're in the industry. Who's your customers? What's your business plan? Market research, all those nuts and bolts that go into creating and running a business. Okay, all red, bold letters. If you haven't done this already, open up a separate checking account. Do not flow any of your revenues through your personal checking account. I've talked about this ad nauseum with Troy, and taxes, I got it. They're boring. They're no fun. That's the last thing you want to do at the end of the day after you've made dinner for the kids and you've sold a house and all. I got it. But those that tend to pay attention to their numbers are the ones that often tend to make more money. So if that's something that interests you, I would highly recommend you get yourself a separate checking account. And with that account, you need something that you can use to keep score of your revenues and your expenses. And we'll talk a little bit more about this lately. There is so many applications out there that you can use. Excel, if you're proficient in the Microsoft Office suite, Excel might be a great choice for you. Some people like QuickBooks. QuickBooks has mobile apps on your phone. They also have mileage trackers on. There's all sorts of different products out there that can help you in running your business. So in the second part, the first bullet there, we're going to talk about ordinary and necessary. And the next slide, we'll go a little bit deeper into what might be some ordinary and necessary expenses for real estate agents. But in the back of your mind, always think, is this ordinary? Is this something that I do in my day-to-day operations to run my business? And is this necessary? Is this expense necessary to generate revenues? And then again, back to the foot stomp on the personal checking. If your plan at the end of the year is to use a CPA to help you prepare your taxes, you can take him a copy of your personal checking account statements and then try and highlight on them all the things that were real estate related and let him sort it out for you. Or you can do it yourself. A CPA doesn't really mind either way, but just know that your bill is probably going to be about 10 times what it would be if you did it yourself. So this is really a means to try and help you save a little bit off the bottom line. And also, real estate, all business is all about cash flow, inflow, outflow. And if you're running your stuff through your checkbook and your personal checkbook and you're using a shoebox for receipts, you probably don't know your numbers. I'm not saying you have to be a mathematician, but you probably ought to know what your cash inflows and outflows are, because then that gives you some predictive analytics to see what next year might look like. I got past performance is not an indicator of future results, but nonetheless, it can at least help as a guide to get you through the process. Okay, so here's, again, I've already stated this, but ordinary and necessary, common and accepted in the trader business is the ordinary, and then helpful or appropriate is the necessary. You know, a lot of times I get asked about, I'm a real estate agent, I have to drive a nice car and I have to wear nice clothes. Can I deduct my clothes? Well, you'll see that I've got some references here in a slide or two that are the IRS publications you can go to and answer the questions with your own eyes. But you know, I think of the example that I give for clothing is, I think of a musical, and somebody had to have a costume made to play Alexander Hamilton. Would they wear that costume out on the street? Well, it's New York City, maybe, I don't know. But here around town, probably not. So deducting suits and ties, you're getting real risky with that. And so these are things that you just want to, you don't have to read this stuff, you know, for leisure reading, but it might be helpful to have a copy of it saved to your desktop on your computer or in a local folder that you can go and reference it. Because at the end of the day, you want to maximize your expenses to the best of your ability, making sure that they're ordinary and necessary, and that everything you're doing is on the up and up. And there's a saying that, well, I can't give my dad credit for it, but he uses it quite a bit. And that's that pigs get fat, hogs get slaughtered. So if you're one of those people that's constantly trying to do things that might not have the perception of being honest, the IRS was there before you. They've got more people than you do, and they'll be there after you. So choose your battles wisely. And so I would always just recommend to people, just be on the up and up and be honest about it. Okay, so common real estate deductions. You can see here, there's some marketing. So if you're getting things printed for like open houses, flyers, printer paper, all that stuff, business cards, mailers, there's a lot of professional development that goes on in the real estate business. And that is also deductible. There's license fees, there's renewal fees, association dues, MLS dues. I mean, you're always paying somebody some sort of a due, and that is deemed as, typically that is deemed as ordinary and necessary. Okay, so transportation. There's, on the next slide, there's a link to the IRS publication for transportation. This is a tricky one. And you really, I encourage everyone to go and read as much of the IRS publication as they can stomach. You know, if you say that you use your car exclusively for real estate, that means that you don't get groceries with it, you don't pick up your children from school with it, you don't take it on family vacations, you don't take it out to dinner on Friday night. It's exclusively used for the agency, meaning that you probably park it in the agency parking lot where it's under lock and key until you get there and you use it again exclusively for real estate. But there's nothing that prevents you from using something partially for personal use and partially for business use. And so the IRS allows you to do that. And they also allow you, the simplest method is I think it's, I don't know if the 2021 rates have changed from 2020, but it used to be 55 cents a mile. And I also know some people, you know, mileage is a bear. I don't care how good you are, how detail oriented you are, but maintaining an app, which I've seen, my wife uses an app for mileage, or she did, you always are going to forget something. And so what some people might do is they'll just keep score of repairs that they maybe had. And a lot of times they'll divide that by 50% business, 50% professional, and then they divide it by the number of miles, and they'll come up with, or divide by 55 cents, and they'll come up with a number of miles to enter. There's lots of different techniques that you can use. Again, I would just say, do your due diligence and report as accurately as possible. Travel, lodging, and meals. I'm going to let y'all read into the IRS publication to the best of your ability. A lot of times you'll see in there a number of 50% can be deducted, and a lot of times you'll see requirements that you have to be out of town. And I think the publications specifically tell you how far away out of town is. So I'll encourage everyone to go in and at least skim the IRS publications. And then of course, you know, gifts, entertainment, other costs, etc. So here's your IRS resources. Business use of your home. This gets tricky as well. Lots of people want to deduct probably more than they're entitled to deduct for their home. There's two methods that I know of that you can do it. in one method, they're going to have you essentially sum up everything: heat, light, internet access, mortgage, all these different things. And then you can take a percentage of that you use for the business. There's also a quick method, and I forget if it's 500 square feet times $3 a square foot or 300 square feet times $5. But last I checked, it's the quick method, and you deduct $1,500 right away, and you don't mess with it anymore. But again, I'd encourage you to read 587 and see which method might best work for you. The car we referenced earlier, that's 463, and then with all kind of a catch-all for a lot of other expenses that a real estate agent might encounter would be in publication 535. Are there any, let me pause for a second. I know I'm going kind of fast. I'll slow it down a little bit unless you're asleep out there, but are there any questions, comments, concerns before I continue on? I'll take silence as no.
I've got a question. Maybe you'll get to it, like on depreciation and stuff.
Let's hold that to the end.
Okay.
Well, so I can have a note here. What are you looking to depreciate?
Well, I'm just curious in terms of like, sometimes, your stuff should be depreciated over a certain amount of time. But then you've also got, like a rapid depreciation on
bonus
certain
depreciation.
Yeah.
Yeah. Like set 179.
Yeah, exactly. Yeah, I couldn't remember what. So like, just kind of like when you should use that, when you should not, like when it's, beneficial, things like that.
Yeah, the first answer I'll say is I don't know. I can't imagine, unless you had a building or perhaps a car exclusively. I mean, maybe you're wanting to depreciate office furniture that's used exclusively for the business. I can't think of, and I could be way out in left field here, but very many items that would be subject to depreciation. These typically depreciation is for, long-term assets, plant, equipment, stuff like that.
Right.
So maybe we can get into it in the discussion at the end.
Okay.
Okay. So here's a good segue into tax time. We talked about identifying yourself as an independent contractor or sole proprietor. We worked that through and told the differences between sole proprietors and employees, that now you're in charge of your own destiny as far as withholding and remitting your own taxes. And then we added in some exclusive deductions, maybe for real estate agents or people in the industry. Now it's time for estimated taxes. Now, as an employee, your employer was doing this for you. This was all happening. And this is something I didn't realize until I started studying tax. This was all happening behind the scenes. My employer was remitting taxes, whether it be weekly, monthly, quarterly, on my behalf. And I never saw it, never knew it. And at the end of the day, they would withheld X number of $1,000 from my check. And then I filed my individual tax return and off I went. But as a sole proprietor, it works a little bit different. And so the government looks at it as, hey, we don't want to wait to the end of the year to get our money. And I'll steal a bullet from the next slide. The government is not a bank. And they're not a bank, and they don't have any interest in issuing interest-free loans while you use all your revenues for the year and not remit your taxes. So you have to pay them at a minimum quarterly. And again, I don't want to make this prescriptive, because maybe you had a quarter where you did not sell a single house. And you say, well, do I have to do an estimated payment? Again, the answer would be, it depends. Probably not. So if you don't have any revenues, you might not have to remit for that quarter. But by and large, what I want to ingrain in your mind is that every quarter we should be remitting taxes. And one technique that I would probably prescribe to if I were a real estate agent would be, is every time I sell a house, I'm going to give some money to Uncle Sam. It just makes it cleaner. And when I strip out what's mine after I've paid off the prescribed commission structure at KW and I've paid off the government, then what's mine is mine. And I don't have to worry about the government anymore. So I don't have to worry about owing a big tax bill at the end of the year. And the second bullet there is, and this gets a little bit tricky, and hopefully you wrap your heads around it better than I did when I first started studying this, is that there's income tax, But then there's also the self-employment, which again is synonymous with FICA, which is your Social Security and your Medicare. And I'll show it to you all in the vignette, but that's going to account for Social Security is going to be 12.4%, and your Medicare is going to be 2.9. So it comes out to 15.3. And you're saying, well, that sounds like double what I used to pay. Well, it is. Because if you remember what I said earlier, not only are you the employer, but you are the employee. So you have to play where when you were a employee at Borden's ice cream factory, the employer paid your share, which was 6.2% of Social Security, and you paid your share of Social Security, which was 6.2. Now, as the sole proprietor, again, you're the employer paying on the employee, which happens to be you. I didn't make this up. You're going to have to remit that. And then when you get to that Schedule C and it flows through to your 1040, I know I'm getting kind of dorky on you, but you're going to get to deduct half of that expense that you paid out initially during your quarterly estimates. So it might make a little more sense when we get onto the actual numbers slide. And then you can see in here that the general rule of thumb is that if you owe more than $1,000, then you're a candidate to remit taxes on a quarterly basis. So just take that for what it is. That's a benchmark. If someone's a babysitter and they made $400 a year babysitting, and they ended up making $100 a quarter, and they don't need to do estimated payments on the $400. Well, they wouldn't have to do it anyway. Say they made $1,000 or $999, $250 a quarter. They wouldn't have to be remitting on a quarterly basis. Okay, so how do you do this? Well, we talked about the 1040 and the 1040 ES. The 1040 ES is really just it's a piece of paper. It's a voucher, and you just write in what you're paying. You tear it off. You put a check next to it, and you mail it in. We probably did that in 1980. I'll show you here in 2 or 3 slides that there's a website that you can do all this through. It's much easier than using the 1040 ES. And again, you know how much money you made, so you're really the only person that can compute what you owe on your estimated tax. And so what's going to happen is let's say you sell a house a quarter, and when you do that, you walk away with $2,500. And so you've made $10,000 for the year. Keller Williams is going to send a copy of the 1099 that they send you at the end of the year as a sole proprietor. They're going to send copy 1 to you, and they're going to send copy 2 to the IRS. So the IRS knows exactly how much money you made for the year. That someone else is already keeping score for you. And believe me, they have lots of people to do it. And so it would behoove you just to kind of keep your own scorecard and keep current with those estimated taxes. Okay. If you've been at this for a year, 2 years, 10 years, 20 years, you probably know when you sell houses the most and when you sell them the least, and what, first quarter, you might owe a little bit. Second quarter, you might owe a little bit more. Third quarter, you might owe a ton because you had the summer surge. You're going into the school year, and then maybe your fourth quarter is slower again. I'm not sure how the cycles work in real estate, but you should start to know your battle rhythm as to when you're going to make the most money and when you need to increase or decrease your estimated payments. And as I said before, at the end of the day, one of the reasons that we're trying to do some professional development as far as the tax front is concerned is because I don't want you to have to pay interest and penalties at the end of the year just because you thought something was way more complex than what it really was. And you just said, well, it's cost of doing business. I'll just pay the interest and the fines and I'll move on with my life. That's a way. I mean, I would recommend you not do that and save a little bit more on your bottom line, but it is a way you can do it. And that kind of ties into my point about the government not being a bank. Okay. So these are the 4 time frames. You can see there it's broken out by the 4 quarters, and then there's the remittance date listed on the far right. So April 15th, June 15th, September 15th, and January 15th. I think the state of Ohio is a little bit different on Q4. I think they're January 18th, but it moves sometimes if they fall on a Saturday or whatnot. But generally, this is the prescribed timeline for when to do this. So that means is March 31st, you had a great first quarter. You sold 18 houses. Good job. You've got 15 days to get your profit and loss or your income statement or your spreadsheet, your QuickBooks, whatever you got going, to get it in order and to get some checks mailed out to the appropriate agencies. Okay. Again, I talked about the 1040 ES. I have not used the IRS To Go app. I haven't even heard anything about it. You'll see here in a minute the website that most clients use. It's it's Eftps or something like that. I can never seem to get it straight. It's Eftps, right? So that is the prescribed website. So now let's just go through. This is a super, super simple vignette. So Phyllis Dunphy is the buyer's agent. She's got some clients that she sold a house to in Dublin, Ohio, and that makes a big difference because Dublin, Ohio has their own tax rate. There are, I don't know, I think there's 340 different municipalities in Ohio, and they all have different rates, and some play nice with others and some don't. Some play with Rita, some don't. So if there's one area that I would recommend a real estate agent start to at least learn a little bit more than they did before is municipality tax, because where you sell that house, you might owe that municipality a cut of the action. And sometimes you don't, but sometimes you do. So full asking price was $300,000. That gave us a $9,000 commission for the agent after we paid the 64-36 split to KW. And again, I'm assuming that none of the caps have been met for the year. I don't know anything about this stuff, but Troy tries to get me smart and it goes in one ear, not the other. So your net $5,400 in your pocket. You got a check from KW for $5,400. And you're thinking, man, all right, I'm gonna go put a down payment on the Corvette and I'm gonna go out to Eddie Merlot's and life is good. And I'll sell another house to pay my taxes. I'll you know what I'll do? I'll sell 2 houses in December and I'll put all that money towards my tax liability. Well, go ahead. I wouldn't recommend you do that. So when people ask, and again, this is not prescriptive. This is just meant to serve as a baseline example to get your minds thinking about who you should be paying and how much you should be setting aside. If anybody asks me off the top of my head, I will always tell them 30%. So, and that's 30% of the $5,400 that you walked away with, because that's the amount that's going to be recorded as part of the 1099. It will accumulate. Every house you sell, the 1099 will grow. But say this is the only house you sold for the year. You're going to get a 1099 at the end of the year for $5,400, and the government's going to want their cut. So I tell people that 30% is $1,620. And that's what's going to go, whether you keep a separate account or you're disciplined enough to keep it in your business account and not touch it. The problem is a lot of people just don't set the money aside. And I got it. Kids need braces, ballet lessons, groceries, vacations. Life gets in the way. But I would encourage some discipline and some due diligence to set that 30% of your net earnings, which is that $5,400 from KW. And then you get to keep $3,780. And that's free and clear of tax for the most part, right? So let's break out the 30%. I'm using 10% as your federal income tax. And you can look at the tax brackets and you can see I think it's for single, or maybe it's married, I think. Married filing joint, 10% is up to like $78,000, and then it goes to 15%, then it goes to 22, and I think 26 or 28. But this is where it gets this is where you kind of need a tax professional, because you're going to have a standard deduction that comes off, and all this income is going to flow through from your Schedule C to your 1040. So I just, as a general guide, 10%. And then, as we talked about a few times throughout the brief, is that self-employment tax. And that's that 12.4, which is 6.2 is the employer, 6.2 is the employee. And then you've got Medicare, which is 1.5 for the employer, 1.5 for the employee. So that works out to 2.9%. Add it all up, it's really 15.3, but I'm a simple guy, so I round down to 15. And then Ohio's tax, there's brackets just like there are on the federal side of things. But as a general rule of thumb, like I did with the 10% for the feds, I use a 2.5% for the state of Ohio. And I used, again, now this is where this is another foot stomp moment. You sold the house in Dublin. And the reason I did that was because the KW office is in Dublin, and that's where you already work. If you work in Keller Williams in Dublin and you sell a house in Pataskala, this example gets a little bit more complicated. I'm not sure if Pataskala or Reynoldsburg or Plain City. I'm not sure who. There's a huge list you can go to from the Ohio Department of Taxation to determine what municipality charges what and if they play nice with others or not. But in this case, I allocated 2.5% for Dublin. So 10%, 15 plus 2.5 plus 2.5. That's my general guidance. The best guidance I can give to you is to withhold 30% of your net earnings from Keller Williams so that 1620 goes into some sort of an account to pay the tax man on a quarterly basis or right away, however you want to do it. And then the other 3780 is retained by you, whether it be for future operations or if you want to do an owner equity draw to pay yourself a little something, however you want to do it. One thing I want to just throw out there, and I know I said the IRS is not a bank, and they're not, but a lot of people get really upset that why would I want to give them, let's just say that hey, Ted, I followed your 30% model and I overpaid the government $2,500 this year. And that's $2,500 I could have used to expand my business. That could have not, I'm sorry. But what I will tell you is that just when you overpaid the government and there's a record, like I told you, they get the 1099 from Keller Williams. They know exactly how much money you made and they know exactly how much money you paid them each quarter. Well, if you overpaid them $2,500, you have two options. You can get a tax return, which is what you used to get as an employee. Or if you're going to be a real estate agent for a long time, well, just apply it to the next quarter. Or maybe you've prepaid for 2 quarters, and we realized that, hey, 30% was way too much based on the number of houses that I sell. You can adjust this on the fly the longer you become an agent. And so you could say, you know what, I want my $2,500 back, and the government will just mail you a check. Or you can apply it to future, or you could even, to get really kind of dorky on you, you could apply $500 and you could pay $500 and you can try and stretch that $2,500 in excess payments as long as you can, because maybe you got a kid that's going to college or you got braces to put on teeth or whatever it may be. There's lots of creative options out there for sole practitioners, sole proprietors, as far as if there is a surplus in the IRS's piggy bank from what you remitted. Where you get into trouble is when there's a deficit. And again, like I said, the IRS is not a bank that issues interest-free loans. So they're going to come after you with penalties and fees. So you're better to be prepaid versus in the hole. One more slide and I'll get off my high horse here. These are the websites I talked about. The Eftps, this is, you can pay for past sins, you can pay for future sins. It is kind of a one-stop shop as far as the federal government is concerned to make yourself whole as far as any federal taxes that you might owe. Below that is the Ohio Department of Taxation. There's that, and then there's also the Ohio Business Gateway that you can go through. This is the big umbrella, and you can drill down into the various portals associated with what you do once you get to the Ohio Department of Taxation. And then, like I talked about, the municipalities, this is super tricky. And I can tell you one thing, Ohio is one of about 5 states that has municipal tax. Most states don't have municipal taxes. And Ohio is the only state, and you can fact check me on this, but I read this the other day. We're the only state in the nation that does not govern what percent each municipality can charge. So some might be 1.1, some might be 1.75, some might be 3.89. There's no governor on any of it. And so we're probably not going to change it today, but as a real estate agent, at least if you know that, you can better navigate those waters and just get people paid up and just move on with your life. Because it also gets a little bit complicated because, and this is the weird part about municipalities, is I have no idea how they know what they know, but they know you sold a house in their town, and you're going to get a nasty grammar, maybe even a nice letter that says, hey, you sold a house here and we'd like our cut. And you'd say, well, I paid Rita. And they say, well, we don't play with Rita. And so you might have to file 12, if you sell houses in 12 different cities and towns, you might have to file 12 different municipal returns as a real estate agent. And like I was going to say earlier is our citizens don't understand it. Tax practitioners don't understand it. No one understands it. All you can do is do your best to try and navigate the waters. And if you've sold a property in a particular area, I would just check in. I'm trying to encourage you to give all your money away, but I would check to make sure that you're not delinquent with that particular municipality. So those are 3 web resources you have. You have the publications, the IRS publications for any questions you have regarding the expenses and deductions. And then you also got some common deductions for real estate agents. And then we started off with contracting versus employees. That's my piece. It is 1:41. I've gone for 40 minutes. I apologize, but about 10 minutes over. I'll open it up to any questions that might be out there. Okay. It's time to wake up.
Can you, hey, and you or Troy, can you guys email that for those links? Can you email that spreadsheet out to everybody?
Troy, get on that. I'm not looking for attaboys or anything, but is something like this useful? And within this brief, is there a topic that you might like me to drill down a little bit farther? Say if we do one of these a quarter or do one of these twice a year or something like that, just kind of a way to sharpen your sword and stay current on the most recent updates on as far as tax policy is concerned for sole proprietors.
I think maybe the
municipalities.
Like, well, you hear a lot with like for LLC or like or S corp and stuff like that. So I think just kind of for real estate agents determining like, okay, at what income point is an S corp beneficial over maybe another type of form of business.
I can tell you just off the top of my head that the cheapest tax bill you're going to get is for a sole proprietor. When you're going between an LLC and whether you want to file as an S corp or a C corp, LLC is a schedule. I'm sorry, sole proprietor is a Schedule C that runs through your 1040, and it's pretty cut and dry. You have Schedule 1s and Schedule 2s and a couple other numerous pieces of paper, but it is by far less complex than doing an 1120 or an 1120S. 1120 is for C corps, 1120S is for S corps. They're more cumbersome on the tax practitioner. They require quite a bit more information. There's a lot more record keeping on your end. You're going to keep balance sheets now, in addition to the income statements and maybe even statement of cash flows. A lot of people like to form LLCs because they like to have LLC after the title of the company, and there's nothing wrong with that. I just would encourage people to read into it, because you're taking on a few other things that you might not have considered, and those things often cost money.
Mm-hmm.
Anybody else before I sign off? Okay, well, thanks everybody.
Thank you.
Find some way to get out of here, and we'll go from there. I'll pass it off to Troy for you.
Why are those not showing? Oh, there.